Hi there, everybody. We've got a great report for you this week. Make sure you flip through put some really interesting articles and also last week's radio show. Today, I want to talk about what if you just bought the world's most admired companies, just the real stalwarts, the Google, Apple, Home Depot, the companies that are the most admired. What can you expect your investment performance to be? And so what I did was went back and took Fortune magazine's top 10 most admired companies in 2001 and wanted to see what the investment performance of those companies had been up until year-end 2013. So we had Berkshire Hathaway, Walmart, Home Depot, GE, Southwest Airlines, Microsoft, Schwab, Intel, Cisco, and Dell, who we actually lost because they went private. So if you put $100,000 in each one of these stocks, what would it be worth on December 31st, 2013? And the best performer was Berkshire Hathaway at $250,000. The worst performer was Cisco at $60,000. So ultimately, what it would have meant is you put 100 grand in, you total balanced it out equally, you would have 175,000 in your investment portfolio 12 years later. Now, what would you have had if you had just a balanced portfolio of really the entire global marketplace? $335,000 in a portfolio. What would have given you the same amount, the $175,000? 20% global allocation to stocks, 80% global allocation to bonds. It's so much less risk that it's really hard to even quantify. You're talking 9 total stocks in this portfolio and 12,000 some odd securities in both of these portfolios. Not one security even outperformed 100% balanced equity strategy. So if you invested this way, you took a lot of risk to achieve not very much reward. Although most of the companies, minus Dell, at least are still, still around per se. So you can balance your portfolio, take much less risk, and ultimately receive what looks to be a much higher reward. All that matters when you're buying these large companies that everybody knows, everybody respects, everybody loves, is they have a lower expected return in the future because their price has been bid up. It is not, unless you have information that no one else has, this is all baked into the price. We actually got a piece of artwork that shows a cake and shows it all baked, it's all baked into the cake because the information is so readily available. So if you have these companies that have been bid up over time, the expected return is lower in the future. It's why you have a balanced portfolio diversified throughout the entire global marketplace. The other thing I wanted to hit on today is unrelated to this, but is talking about, and I've talked to several people over the past several weeks, really, talking about waiting for a dip in the price of securities to have their money invested. And to me, that's all well and good if you're trying to make a gamble or a bet on something. If you're trying to invest your money for a long period of time, what happens in the next week or next month means nothing. And if you are putting money in equities, then you really should have 10, 20, 30-year time horizon. If you've got it in the next 6 months, essentially what you're doing is making a bet. And I can promise you, you don't know if the market's going down, up, or sideways between now and the next week or 2 weeks or 6 months or whatever it may be. It's why we invest. We don't take gambles and take bets. And that's the opportunity you have. I've mentioned this so many times, is you can be the house. You can be the globally diversified portfolio that's going to really always win, at least over time. This portfolio, you take a lot of chance and you can win on the short run. Or if you're trying to time it, you can win on the short run. But being the house always wins. So if you have more questions about that, how can I implement this strategy and take advantage of the entire global marketplace and maximize return and minimize risk, then give us a call, 770-984-2312. Until next week, hope your money's making money for you.